Welcome back to Investing Talk Podcast.
So today we're going to tackle something a little different. We're not talking about a meme stock.
Right.
We aren't talking about a short squeeze. We are taking a very serious look at GameStop. But, and this is the key thing, not the GameStop you think you know. We're looking at a company that is going through, arguably one of the most aggressive strategic shifts in, retail history.
Okay, yeah, that's a big statement.
They're moving from being a mall-based video game seller to a holding company model that looks, a lot less like a retailer and a lot more like a conglomerate.
Okay, let's unpack that right away because conglomerate is that's a heavy word for a place I used to trade in scratched Xbox games for, like $5.
Right.
The core tension here seems pretty obvious to me. Is this a failing brick-and-mortar retailer that just, got lucky with a cash injection a few years ago?
Exactly.
Or are we actually looking at the early stages of a budding giant that's, targeting a $100 billion valuation?
Yeah.
Because those are two very, very different realities.
That is the question, and it's the question we're going to try and answer. Because when you strip away all the internet noise, all the hype, and you just look at the raw data, you see a company that has swung back to profitability, sits on a literal mountain of cash, and is effectively being priced for a massive transformation.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really, really helps us keep the lights on and keep digging into these numbers for you.
It does.
Okay, so lay it out for me. What is the actual thesis here?
So here's the elevator pitch that really got my attention. You've got this legacy brand that, the entire institutional world basically wrote off for dead.
Completely.
But quietly, in the background, they've cleaned up their books to a level that is, frankly, shocking. We're talking about a fortress balance sheet.
Okay.
And now the market is starting to whisper about this transformation, that it could turn into a holding company for all sorts of diverse assets, not just gaming. Think less blockbuster video and more, early Berkshire Hathaway.
All right, that is a massive claim. Comparing a game store to Berkshire Hathaway it's bold.
It is.
So let's strip away the hype and actually look at the balance sheet. Because narratives are fun, but the numbers, they don't lie. Walk me through the fundamentals here. What's actually happening under the hood?
Let's start with the top line, because this is really where the turnaround story begins. We're looking at the data for the second quarter of 2025.
Okay.
GameStop reported revenue of $972.2 million.
Right.
Now, to put that in context, that is up 21.8% year over year.
Okay, I have to pause you right there.
Sure.
21.8% growth for a physical retailer in 2025. That is way higher than I would have expected. Most mall retailers are just fighting to stay flat. Usually we see these legacy chains happy with 1, maybe 2% growth.
It is huge. And to show you how much the market underestimated them, they beat the consensus estimates of $823.25 million.
Wow.
So they didn't just scrape by. They blew past expectations by almost $150 million. But honestly, the revenue is only part of the story.
Right. The real magic and the real weirdness is happening in the earnings per share. Or EPS.
Okay, the EPS. Because for years, the whole story with GameStop was just bleeding cash. It cost them money just to open the doors in the morning?
Not anymore. For the third quarter of 2025, their EPS came in at 24 cents. The expectation was 20 cents.
Another beat.
Another beat there. But if you zoom out and look at the trailing 12-month EPS of the last full year of performance, it's at 73 cents. And here's where it gets really interesting.
Why?
Analysts are projecting 125% growth for next year.
Okay, wait, 125% growth in earnings. That's aggressive. That's tech startup numbers, not retail numbers. What is driving that? Is it just selling more consoles?
No.
Because there are only so many PlayStations you can sell, and the margins on hardware are, notoriously thin.
No, and this is the key insight that I think most people miss. If you look at the operating income for Q3, it was $96.9 million. That's the money they made from, selling stuff.
But look at where a huge chunk of their total money is coming from. They reported $185.5 million in net interest income.
Okay, hold on. Let me just make sure I understand this. Net interest income. That basically means the interest they're earning on their savings, right?
Precisely. It's the yield on their cash pile.
So they are making nearly double their operating income just from the interest on their bank account.
Yes. And this is why I used the phrase holding company earlier. A huge portion of their profit isn't coming from selling Zelda cartridges, it's coming from capital allocation. They're sitting on so much cash, billions of dollars, that the interest alone is acting like this massive safety net and a profit driver. They've essentially become a bank that happens to sell Funko Pops.
That drastically changes the profile of the company. It's less of a retailer and more of a, well, an investment fund with a gift shop attached to it.
In a way, yeah, and that changes how you value it. Look at the trailing PE ratio, the price to earnings. It's currently sitting at 31.88.
Right.
Now, usually for a dying retailer, you'd expect a PE of maybe 8 or 10. A PE of 31 suggests the market is expecting growth. You have to contrast it with where they were. In 2023, their EPS was 2 cents.
2 cents.
2 cents. Now they're at 33 cents for 2024 and trailing at 73 cents. That is a profitability turnaround that you rarely see without a bankruptcy filing in between.
It is impressive financial engineering. I will give them that. But let me push back a bit here.
Go for it.
You mentioned capital allocation. If they're just sitting on cash and collecting treasury yield, that's safe, sure. But it's not exactly a growth strategy. I can go buy T-bills myself. I don't need to buy GameStop stock to do it.
Sure.
What are they actually doing with the money to build the business?
That's the multi-billion-dollar question. They maintain what I would call a pristine balance sheet, net income of $131.3 million over the last 4 quarters.
Okay.
They're not burdened by debt, which in this high-interest environment is a massive advantage over their competitors. And they are making moves to streamline. In Q2 2025, they divested their Canada operations.
Selling off the Canadian arm. To the average listener, that sounds like shrinking, not growing. That sounds like a retreat.
It looks like that on the surface, but in corporate finance, we'd call it shrinking to grow. You cut the fat, the low-margin areas to streamline operations so you can reinvest that capital into higher yield opportunities. And they're not just sitting on dollars. The reports show they are using that cash for Bitcoin investments and positioning for potential acquisitions.
Okay, the Bitcoin thing is a whole other can of worms. That certainly signals they're not playing by the traditional retail playbook.
Yeah.
A normal CEO doesn't put the corporate treasury into crypto. But let me play devil's advocate again. Steam exists.
Yeah.
Digital downloads exist. I haven't bought a physical game disc in 5 years. Why does GameStop still have a business? What is the moat? What protects them?
The moat is kind of twofold. First, believe it or not, it's the loyal retail footprint. That physical presence allows for events, collectibles, and a tactile experience that Steam just cannot offer.
It's a hub.
It's a hub. You can't trade in a digital download. You can't go to a midnight launch event on Steam and meet other people, right?
Sure, but is that enough to sustain a multi-billion-dollar company?
Yeah.
Just nostalgia and trade-ins.
By itself, maybe not. But the second, and maybe the bigger moat, is Ryan Cohen himself.
The CEO.
The CEO and his capital allocation expertise. I mean, look at the market cap growth. It went from $1.3 billion in 2021 to $9.3 billion.
Right.
That growth wasn't driven by selling more games. It was driven by the market's faith in his ability to allocate that cash pile effectively. The stores protect the downside, they keep the cash flowing, but Cohen's checkbook offers the upside.
So investors are betting he's going to take that cash and buy something that generates massive returns.
That's the bet.
So the thesis is,
Yeah.
the stores keep the lights on, but the CEO is the real engine.
Exact.
Okay, that's the internal engine. Now let's look at the price action. Because fundamentals are great, but the chart tells us what people are actually doing with their money. What are we seeing there?
Right. Let's look at the tape. We are seeing a breakout. The stock recently closed at $23.88. That's a 4.8% climb.
4.8% isn't huge in the world of crypto or tech. We see that in an hour sometimes. But for a retailer, that's a pretty solid move.
It is, but it's the context of the move. This is a breakout on volume. It signals that investors are pricing in this transformation potential we've been talking about. They aren't buying it for the earnings beat yesterday. They're buying it for the acquisition news tomorrow.
So it's anticipatory. The market is trying to front-run the news.
Completely. The momentum is pushing towards that psychological resistance near the recent highs. And when you look at the flows, there's just clear buyer conviction following all these recent acquisition headlines. The market is digesting Cohen's vision.
Volatility is usually a scary word for, retirees, but here it sounds more like opportunity.
In this case, yes. The gains reflect that digestion period. The market is waking up to the idea that if this vision is confirmed, if they actually pull off a major acquisition, there is sustained upside here. It's not just a flash in the pan squeeze like in 2021.
Okay, the charts show movement, but what is the street actually feeling? We know the apes, The retail superfans are always bullish.
Of course.
They'd be bullish if the store burned down. But what about the broader sentiment? What are the quants saying?
It's surprisingly robust. If we look at the quantitative scoring from a place like Alpha Vantage, the weighted sentiment is squarely bullish.
Okay, break that down for people listening. How do they even calculate that?
Basically, they analyze news headlines, market chatter, and they assign a score to it. Recent news items are scoring around 0.05, which is sort of somewhat bullish.
Right.
But then we have scores of 0.39 and 0.25, which are firmly bullish. So when you average that out, the narrative isn't fear, it's optimism. The algorithms are picking up on a positive shift in the language being used around the company.
And what's the specific headline that's dominating that sentiment? Is it just the earnings beat?
No, the earnings are just the foundation. The narrative is the goal. There's a headline circulating about Cohen's plan to target a $100 billion valuation via a major acquisition in the consumer or retail space.
$100 billion. Okay, stop. That's massive. That is 10 times where they are now. Around 9 or 10 billion today. A 10x return would make them bigger than companies like, I don't know, Starbucks or PayPal.
It is huge. And that is why the sentiment is so strong. It's the what if. And while we haven't seen specific analyst upgrades for 2025 explicitly mentioned yet, the market reaction is effectively a positive repricing.
Yeah.
The market is saying, we believe there is a non-zero chance this actually happens.
That sounds like a lottery ticket.
It has lottery ticket characteristics, but with a safety net. But there's one detail in the research that I think is crucial for anyone listening to understand why the market believes this might be real.
Oh.
It's about insider alignment. Tell us about January 7, 2026.
Right. Yeah, this caught my eye too. Ryan Cohen received a long-term performance award on January 7, 2026.
So very recently relative to our timeline.
Exactly. And the key is that this compensation is tied directly to stock upside. He doesn't get paid a salary. He doesn't get a bonus if the stock stays flat. He doesn't get paid if the company just survives. He only wins if the shareholders win.
That is the ultimate skin in the game, isn't it? Most CEOs get a salary regardless of whether the stock tanks. Cohen is making a bet on himself.
It sounds perfect, but, my job is to be the skeptic here. Let's look at where this could all go wrong. Because a $100 billion valuation is a moonshot. And moonshots often explode on the launchpad.
You have to look at the execution risk. It is massive. Skepticism is high among the institutional crowd. Wedbush, for example, gave the $100 billion goal less than 0.001% odds.
Less than 1/1000th of a percent. That's basically them saying it is impossible, and you're delusional for even thinking it.
It is the genius or foolish risk. If he pulls it off, he's a genius. If he doesn't, the valuation collapses. And we have to be honest about the track record. It hasn't all been wins.
Right. We mentioned Bitcoin earlier.
The Bitcoin buy, it gave the stock an initial bump, sure, because crypto was hot, but then it dropped 10%. It was volatile. And then remember the whole pivot to trading cards and NFTs a couple of years ago?
I do. That was supposed to be the next big thing.
And it resulted in a 20% drop. The NFT marketplace just didn't gain traction. These were experiments that didn't exactly yield steady returns. There were swings and misses.
So the concern is that he might take this massive cash pile, this pristine balance sheet we keep praising, and bet it on something that fails. He could buy a dying company or invest in a fad, and suddenly that cash cushion is just gone.
That is the totally foolish narrative. If the acquisition deal fails, or if they buy the wrong thing, you have to ask yourself a hard question. Is the current $11 billion market cap justified purely on retail earnings?
Probably not. If you strip away the acquisition dream, you're paying a huge multiple 30x earnings for a retailer in a shrinking physical market.
Exactly. If the dream dies, the stock price likely corrects down to its fundamental retail value, which is lower.
Right.
However, the counter-argument is that the cash hoard helps manage these risks. Even if they make a mistake, they have the liquidity to survive it. They aren't leveraging the company to the hilt to do this. They aren't borrowing billions to make these bets. They're using their own money.
So it's not a leveraged buyout situation where one bad move just kills the company.
Precisely. It's a low-debt, high-cash environment.
So do we buy the transformation? We have the numbers, the charts, the sentiment, and the very, very real risks. Where do you land on this?
When I weigh everything, the turnaround in EPS, the interest income providing a floor, and the upside of the cash allocation, I am awarding this a bullish score of 810.
An 8 out of 10, that's confident, especially given the impossible odds from a firm like Wedbush.
It is. Here's the investment thesis, boiled down. You have a company that has proven it can fix its core business. Revenue is up 21.8%. They beat earnings. The balance sheet is pristine. You are essentially buying a call option on a transformative acquisition, but you aren't paying a premium that assumes it's already done. You're getting in before the news drops.
So you're paying for the retailer and getting the conglomerate potential for free.
Close to it, yeah. And with the insider alignment via those January 2026 performance awards, you know the CEO is motivated. He wants that stock to go up just as much as you do.
So what's the time frame here? If I buy this today, am I looking for a trade for next week?
No. This is not a swing trade. This is a multi-year hold. You are holding this into the acquisition close. You are waiting for the transformation to materialize.
Yeah.
If you sell next week, you might miss the one headline that changes everything.
It's a patience play. You have to be willing to hold through the boredom.
Absolutely. Watch the Q4 earnings. Watch for deal catalysts. But don't expect it to happen overnight. This is a long-term strategic shift.
Fascinating stuff.
Yeah.
It really seems like GameStop has sort of graduated from the meme wars into something much more interesting, corporate finance-wise. It's certainly not boring.
It's definitely one to watch.
Don't forget to subscribe, like, and comment. We'll see you in the next one.